Hey everyone, welcome back to Corporate Decoder. Today we're diving into the financial filing of Borr Drilling, a company that owns and operates a fleet of jackup rig. Think of a floating platform that can anchor itself to the seabed with huge legs used for offshore oil and gas drilling. And what do you call a jackup rig that won't move? Immobile, if you get my drift. Alright, let's see if this filing is worth its salt. First off, as of the end of 2024, Borr Drilling had almost 245 million common shares floating around. This number is important for calculating key financial metrics like earnings per share basis. Borr Drilling is registered with the Securities and Exchange Commission, also known as the SEC, with something called Commission File Number 0013907. Think of it like their identification number with the SEC. This document is a Form 20F, which is basically an annual report that foreign companies listed on US stock exchanges have to submit. It's similar to a 10K for US-based companies, giving investors a deep dive into their past year. This report covers the business year that ended in December of 2024. Like any good report, there's a table of contents. This helps anyone quickly find specific sections from risk factors to financial statements. The company mentions adjusted EBITDA, a non-GAAP measure. What does that mean in plain English? Well, it's a way of looking at a company's profit that cuts out some of the accounting stuff to focus on core operations. It helps investors get a clearer picture of performance. Here we see that during 2024, Borr Drilling tweaked how they calculate adjusted EBITDA. Now, why would a company change a definition? They say it's to align better with how their industry buddies do it. All right, let's get to the nitty-gritty. Part 1 covers the basics of Borr Drilling. Here we go. What keeps Borr Drilling awake at night? This section spills the beans on all the potential threats to the company's future. First, the offshore drilling industry is a roller coaster. It has periods of boom and bust and periods of high and low demand, which can really mess with Borr Drilling's business. Next, it's a competitive market. There are periods with a lot of rigs, which means prices or day rates go down. Here's a big one. Borr Drilling's success is closely tied to the oil and gas industry. When oil prices are high, there is more drilling. When oil prices are low, drilling activity declines and the company utilization and day rates are affected. Oh no, this section admits that future cash flow might not be enough to cover the bills, including what they owe on their loans and bonds. This could really impact their ability to operate. Drilling internationally is a compliance minefield. Messing up these rules can cost a lot and hurt operations. They need to spend money or make changes to follow all the environmental rules, which could reduce their profits or make the rigs less valuable. New rules might limit what they can do or increase costs. Tax laws can be a headache. Changes can negatively impact their financial results. Data protection laws can increase costs, and messing them up can lead to fines and bad press. Here's a warning to investors. Their stock price is like a yo-yo. Be prepared to lose money. If they issue more stock, or people think they will, the stock price could drop. They voluntarily delisted from the Oslo Stock Exchange. While this might simplify things, it could also reduce the stock's trading activity and price. Let's switch gears and find out a bit more on Borr Drilling. Borr Drilling was born in August 2016 in Bermuda. They describe themselves as a leader in owning and operating jackup rigs, those offshore platforms with legs in shallow waters around the world. Diamond for Our Services showed up twice, and they seem pretty proud of being committed to safety and environment. They have a bunch of subsidiaries which you can see in the exhibits, but there are 2 that are 51% and are related to operations in Mexico. This section is empty. That is always good, as it means the SEC had no issues with their previous filing. Now for the real meat of the filing. This section digs into how Borr Drilling has been doing and what they expect in the future. They are reporting that contract backlog, excluding their joint venture, is about $1.4 billion. It's important to note that this is just an estimate. Technical utilization, that is how efficiently a rig can operate without hiccups. It was about 99% over the past year. High number is good. Economic utilization reflects how much money their operating rigs are actually making compared to their potential. It was 97.7% during 24, pretty close to the top. TARF is a good metric. Think of it as safety metric, tracking workplace injuries and illnesses. A lower number is better here. This section outlines that a lot of the business depends on cash from the joint ventures and from Pemex. They also depend on cash from their subsidiaries to pay obligations, so anything that disrupts that cash flow, like exchange rates, and may cause problems. Borr Drilling has some big debts coming due. They will have to figure out how to pay it back or refinance. That's a large bill that they need to pay, and that eats into the flexibility to grow. They might have to sell more shares, which can dilute current investors, or take on more debt, which can make things even tighter. If they are unable to transfer cash from their subsidiaries, they may not be able to meet their debt. Don't forget about cybersecurity. Cyber attacks can disrupt operations, damage reputation, and cost extra money to fix. A scroller year ended December 31